AMD just delivered the strongest quarter in its history. Revenue reached $11.54 billion, up 50% from a year earlier. Its data center business more than doubled to $6.72 billion, and management forecast another record quarter ahead. Then the stock fell almost 9%. Nothing had collapsed. AMD beat revenue expectations, beat profit expectations, and issued guidance above Wall Street's forecast. But after the shares had already climbed sharply during the year, investors were no longer asking whether AMD was growing. They were asking whether it was growing fast enough to challenge Nvidia. That is the contradiction at the center of AMD's transformation. The company is becoming a much larger force in artificial intelligence, but success is being measured against one of the most dominant businesses in technology history. Good results are no longer enough. AMD must prove that customers will trust it with entire AI data centers, not simply purchase a few alternative chips. For decades, AMD was best known as the company competing with Intel in personal computers. It sold processors that often offered strong performance at lower prices, but it regularly operated from the position of challenger. Under Chief Executive Lisa Su, AMD rebuilt itself around high-performance computing. Its Ryzen processors revived the PC business. Its EPYC server chips took market share from Intel. The acquisition of Xilinx added adaptive computing technology, while the purchase of ZT Systems gave AMD more experience designing complete data center systems. Now AI has created a much larger opportunity. The AI accelerator market has been dominated by Nvidia because Nvidia does not sell only powerful processors. It sells a complete environment. Customers receive GPUs, networking, software libraries, development tools, and systems designed to work together. A chip may perform trillions of calculations every second, but that does not automatically make it useful. Developers need software that can translate models into instructions the hardware understands. Data must move quickly between processors. Memory must feed the chips without creating bottlenecks. Thousands of components must behave like one machine. This is why Nvidia's advantage is difficult to attack. AMD can design a competitive accelerator, but the customer is not comparing two isolated pieces of silicon. The customer is comparing two ecosystems. AMD's strategy is therefore changing. Instead of asking companies to purchase an AMD chip and assemble everything else themselves, it wants to deliver the complete AI system. Its Helios platform combines Instinct accelerators, EPYC server processors, networking equipment, memory, software, and rack-scale engineering. In practical terms, AMD wants to sell the entire row of machines inside a data center rather than one component inside each machine. This matters because large AI customers are no longer buying chips by the hundreds. They are planning facilities containing tens of thousands of processors. A single deployment can require enormous electrical systems, cooling infrastructure, networking, and specialized software. The customer wants predictable performance. If one company can deliver a tested rack containing processors, networking, and software, installation becomes faster and less risky. AMD can also capture more revenue from each project. Imagine a company that once sold engines but now supplies the engine, transmission, electronics, cooling system, and vehicle platform. Even if its share of the engine market remains smaller, the value of each customer relationship becomes much larger. AMD's second quarter results show that this transition is already reshaping the company. Data center revenue reached $6.72 billion and represented roughly 58% of total quarterly revenue. A business once associated mainly with PCs and gaming consoles is increasingly dependent on servers and AI infrastructure. But that also explains why investors reacted so harshly. AMD's revenue forecast was strong, but the company's share price had already incorporated enormous expectations. When a stock rises because investors expect exceptional growth, merely delivering exceptional growth may not be enough. Suppose a restaurant normally serves 100 customers but investors expect 200 next year. If it reaches 180, the business has grown dramatically. Yet the market may still react negatively because reality fell below the expectation already reflected in the price. AMD faced the same problem. Its shares had risen substantially before the report. Investors were hoping for guidance that would suggest an even faster acceleration in AI sales. The company forecast approximately $13 billion in third-quarter revenue above analysts' expectations, but the difference was not large enough to satisfy the most optimistic assumptions. There is also a customer concentration risk. AI infrastructure is being built by a relatively small number of extremely large companies. Microsoft, Meta, Amazon, Google, Oracle, OpenAI, Anthropic, and a limited group of specialized providers account for a major share of advanced AI spending. Winning one of these customers can generate billions in revenue. Losing one can create a noticeable gap. AMD has worked to secure large commitments from customers including Meta and Anthropic. Its agreement with Anthropic includes infrastructure based on future AMD accelerators and systems, while AMD has also discussed investing up to $5 billion in the AI company. These relationships help validate AMD's technology, but they also show how closely chip suppliers and AI companies are becoming financially connected. The manufacturer helps finance the customer. The customer promises to purchase infrastructure. Both sides benefit if AI demand continues growing. But if customers reduce spending, delay facilities, or change hardware strategies, the supplier may lose both revenue and the value of its investment. AMD must also compete with customers that are designing their own chips. Google has its TPUs. Amazon has Trainium. Microsoft, Meta, and other large companies are investing in custom silicon. These chips may not replace Nvidia or AMD completely. General-purpose accelerators remain valuable because they can support many different models and workloads. But custom chips can reduce costs when a company performs the same task at enormous scale. AMD is therefore fighting on three fronts. It competes with Nvidia's general-purpose AI platform. It competes with custom processors developed by cloud companies. And it competes for the manufacturing capacity, advanced packaging, and high-bandwidth memory needed to produce these systems. The third battle is less visible but critical. Modern AI accelerators require more than advanced silicon. They need specialized memory placed extremely close to the processor, complex packaging that connects multiple components, and manufacturing capacity at companies such as TSMC. If demand rises faster than supply, AMD may have customers ready to buy but not enough finished systems to deliver. AMD does not own the factories producing its most advanced processors. Its fabless model allows it to avoid spending tens of billions of dollars constructing semiconductor plants, but it also makes the company dependent on manufacturing partners. Nvidia depends on many of the same partners. This creates a race not only to win customers, but to reserve enough production capacity before competitors take it. Software remains the more difficult challenge. Nvidia's CUDA platform has been used by developers for years. Researchers, startups, universities, and large corporations have built software around it. Switching hardware can therefore require more than replacing one machine. Companies may need to modify code, retrain engineers, test performance, and solve compatibility problems. AMD promotes an open software approach through ROCm. The argument is attractive. Customers do not want one supplier controlling the price and direction of the entire AI computing market. A credible alternative gives them bargaining power and protects them from dependence on Nvidia. But open software succeeds only when it works reliably. A lower-priced processor does not save money if engineers spend months fixing software problems. For AMD, improving developer experience may be as important as improving raw chip performance. This is why its move toward complete systems matters. When AMD controls more of the platform, it can test the hardware and software together before delivery. Customers receive a more standardized environment, reducing some of the integration work that previously limited adoption. The company's future products are designed around this idea. AMD introduced the MI400 accelerator family and Helios rack-scale systems as part of a broader portfolio that includes CPUs, GPUs, networking, and software. It is trying to position itself as the open alternative for customers that want powerful AI infrastructure without depending entirely on Nvidia. Yet AMD does not need to defeat Nvidia to build an enormous business. The global AI infrastructure market is expanding so rapidly that even a minority share could produce tens of billions of dollars in annual revenue. Large customers also prefer having more than one supplier. Depending completely on a single company creates pricing risk, supply risk, and strategic vulnerability. AMD's strongest opportunity may therefore be as the essential second supplier. A cloud company might continue using Nvidia for its largest training clusters while deploying AMD systems for inference, specialized workloads, or additional capacity. As AMD's software improves, its role can expand. This is similar to the commercial aircraft market. An airline does not need one manufacturer to disappear for the other to become extremely valuable. Large buyers benefit from maintaining competition between suppliers. The risk is that Nvidia continues moving faster. Nvidia is not waiting for AMD to catch up. It launches new architectures, networking products, software services, and complete systems at an aggressive pace. Its enormous profits allow it to spend heavily on research, acquire technology, and secure supply. AMD must invest while earning far less from AI. That makes execution critical. A delayed product generation could push customers back toward Nvidia. A software problem could damage confidence. A supply shortage could allow a rival to lock in multi-year contracts. The latest quarter proves that AMD is no longer a minor participant. Its data center business has become the company's largest growth engine, and revenue is rising at a speed that would be extraordinary in almost any other industry. But the stock decline reveals the new standard AMD faces. Investors are not judging it against the AMD of 5 years ago. They are judging it against the scale of the opportunity and the dominance of Nvidia. AMD has already completed one transformation, from a struggling PC chipmaker into a leader in high-performance computing. Its next transformation is harder. It must become the company that can deliver an entire AI factory, including processors, networking, software, and systems that thousands of machines can run reliably. The second quarter numbers show that customers are buying into that vision. The market's reaction shows that AMD still has to prove how large it can become.